This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Chapter 6 deals with corporate governance and certain ethical considerations. Corporate governance and ethics is a big subject in business. Came really to a head, I suppose, when maybe about 10 years ago now, we had a couple of very large scandals that they had in America, Enron and WorldCom. Very, very large companies who failed. And it was then discovered that there were people running those companies who were not running them in the best interests, perhaps, of their shareholders. Corporate governance deals with how companies are directed and controlled. And the problem really arises when a company gets large and you have this separation between the shareholders who own the company but don't have any day-to-day responsibility for running the company. We're thinking really now listed companies on the stock exchange, hundreds of millions of shareholders all over the place, all over the world maybe, and they can't run the company. And essentially what happens is you appoint directors who are supposed to be running the company on the shareholders' behalf. These directors are what is known as the agents of the shareholders. The directors should be acting in a way which is in the best interests of their shareholders rather than in their own best interests. But of course, these directors who have day-to-day management have got such power over what happens in the company day-to-day that the temptation is that they begin running the company in a way which is good for directors and which might not be good for shareholders. A simple example would be the directors in some way arranging for themselves to be paid a very large remuneration or bonuses which are very easy to earn, which don't take very much effort, or giving themselves fantastic perks, fancy cars and company aeroplanes and all this sort of thing. It's not only that, it's not only these obvious things, but sometimes what the directors do is they have a feeling I'm gambling with somebody else's money, really. It's the shareholders who own the company. And directors might take risks in the hope that they pay off, and the directors will suffer very little if these risks don't pay off, and it's the shareholders who will suffer. Especially great temptation here if the directors perhaps pay is linked to the share price. So if the share price goes way up, the directors get fantastic bonuses, the share price goes down, maybe the directors don't lose a lot, whatever way it's kind of asymmetrically structured. And so you encourage directors to take high risks, but the people who lose out, if these risks end up in grief, will be the shareholders. So it's how you get over this agency problem. You want some way to try to make sure that directors do act in the best interests of their principals. These are principals, the directors, the agents here. Sometimes as the term stewardship is also talked about. Stewardship is the idea that the directors are the stewards. They should be looking after the assets of the company on behalf of the shareholders, and they should do nothing which puts those assets at undue risk. Nobody's saying there should be no risk. Everyone accepts that you can't run a business without taking risks. Will this new product be popular, etc., etc.? But it's a matter of making sure that the shareholders know what the risks are fairly and can say no to the directors or can sell up their shares in that company and go to a safer one if that's what they prefer. So, what are the main elements we need to look at here in corporate governance? And first of all, good corporate governance, and this what we're talking about tends to be modelled on what's called the UK Corporate Governance Code. We know every country has got a slightly different code and so on, but in this exam you can take the UK Corporate Governance Code as a reasonable base model here. First of all, there is the board that we talk about, the board of directors here. And what the Corporate Governance Code is saying is it's really the responsibility of the board as a whole to determine the strategy of the company and to look at where the risks are that the company might be exposed to. I might think that's obvious. Surely that's what the board, its purpose is, the board of directors, to run the company, really. But what they found was happening in some of these abuses of corporate governance was, for example, the board rarely met. What you had is a very powerful chief executive officer who would maybe go to one board member and kind of get that board member on side, get them agree, go to a second board member quite separately and kind of get them on side and so on. And then if there was a kind of board meeting, everybody would vote yes, because everyone had been kind of pre-arranged to say yes. What you need is the board to take joint kind of responsibility. So you want things to be discussed openly at the board and not for these kind of side arrangements and so on to be made by this very powerful chief executive officer. So the board is responsible for the strategy of the company. The board is responsible for, as I say, identifying the risks that the company is prone to. The board is responsible for looking at internal control, making sure there's proper internal control in a company's operations. Because how could you run a company properly if you didn't have reporting mechanisms that, for example, looked after the financial accounting properly? If you weren't getting accounts produced monthly in a way that you could interpret something about the performance. One of the problems that they had on the board here was that in some of these companies which failed, you had the same person being the chief executive officer and being the chairman. So the chief executive officer is the person who looks after the day-to-day activities of the company, and the chairman is the person who should really be running board meetings. And if the chairman and the chief executive officer are the same person, the two roles are in one, then you have a very, very powerful person at the top. You run the company and you run the board. So one of the things that corporate governance codes kind of insist on here is that you have the chief executive officer. It's not the same as a chairman. That these roles have to be split at the top. So there's a kind of an element of power sharing at the top. This very dominant chief executive officer can't get it quite all his way or her own way. There's a chairman there who can insist that things are talked about properly at the board meeting, make sure everyone has their say, etc., etc. So they have to be split, diffusing the power that had been concentrated into two. Second, really, effort at diluting the power of the chief executive officer was the insistence that you have on the board non-executive directors. So non-executive directors are people who, in a way, turn up to board meetings. They can vote at board meetings and so on. They can advise. They can warn. They can keep an eye on the operations of the board and so on. But they do not have day-to-day executive power. They're not in charge of manufacturing or sales or accounts or IT or something. They're not really at the company other than for these board meetings. And there has to be the phrase used in the UK Corporate Governance Code. There has to be a balance of executive and non-executive directors, which roughly means 50-50. 50% of the board are executive directors who have got day-to-day hands-on responsibilities, 50% non-executive directors who are essentially independent. They will be paid to attend the board meetings, but their pay does not depend on the success of the company. And the reason for that is, if you have your executive director, your CEO, if your remuneration is dependent on the success of the company, then this can lead you into making risky decisions, and I hope that they pay off. Whereas if you are a non-executive director, your pay doesn't in any way depend on the success of the company, you're much more objective, much more independent. You can say, well, I think that's high risk, and kind of, whereas the other people will say, I know it's high risk, but I might get a high pay out of it. Some of the abuses that happened before, we're still dealing with board members, were as follows. Remuneration. They would arrange for themselves to be paid perhaps amounts which were out of step with what you might say was the going rate for companies of that size. All the bonuses were very, very easy to win and very, very hard to lose kind of arrangement. Nomination refers to the appointment of new directors. And again, there had been a kind of almost club going on where one director would, I suppose, appoint or put up for appointment his friend, and then the friend would appoint that other director to be a director of that company and so on. Yeah, you had a kind of almost incestuous relationship there. You appoint the people you're friendly with, and maybe you appoint the people with whom you have some influence there. Now they're saying that nomination here should be like appointing any other employee. You should advertise. You should draw up a short list of people who might be suitable. You should interview them. And you should, as objective as you can, give the job to the best person. The person who's going to be best at IT director, finance director, whatever it is, not your friend, not your crony that you maybe owe a favour to. And then finally, the audit committee here, there are external auditors who come in, they check through the financial statements. Financial statements is how the company reports to its shareholders annually. And the auditors fulfill this very important function of making sure that the financial statements do not have what's called material misstatements within them. And there was a kind of a bit of a problem there. The auditors find some error in the financial statements. Historically, they would go to the finance director, and the finance director might try to keep it quiet. They might say, oh, gosh, this looks as though I made a mistake, and might kind of suppress, if you like, the discussion of that at the board meeting. If a fraud was discovered by the auditors, again, that will be discussed with the finance director. The finance director would be deeply embarrassed about the fraud, would try and kind of keep that quiet. And an audit committee is a committee to which the auditors will report. These three committees, Remuneration, Nomination and Audit Committee, are comprised of non-executive directors. So these non-executive directors, these independent people, have really the say over what pay they think is fair for the executive directors to get. These are the people who will be dealing with the appointment of new directors to make it independent. And these are the people to whom the external auditors would report about problems in the financial statements, problems encountered during the audit and so on. And then the non-executive directors would bring that up at the full board meeting. There would be no reason for the non-executive directors to kind of suppress, to hide some sort of problem. They were independent of all of this. And even though the finance director didn't like it, it will be made public. The reporting which has to be carried on here, all I'll say about reporting was that historically, reporting was about once a year when the financial statements were published. But once a year, reporting once a year gives you 12 months, maybe more than 12 months sometimes, before the shareholders really hear anything from the company and from its directors. The corporate governance code says this is a bit long. There's an awful lot can happen in a year or 15 months, something of that type. And it's now important that the directors report, if you like, for want of a better expression, shall we say, material occurrences which are happening during the year. So if one of their products is found to be faulty and they have to withdraw it from the market, and this is obviously going to affect the profits for the year, they have to announce that soon. Because what is the justification of keeping the owners of the company in the dark about that, and so on? They have to encourage good communication. It's a part of the corporate governance code that the directors must encourage good communication with the shareholders and participation of these shareholders as far as they can. There are two approaches to corporate governance in the United States. It was brought in something called the Sarbanes-Oxley Act. That's very what's called compliance-based. There's a big checklist that has to be signed off both by the directors and the auditors. Yes, we've done this, etc., etc. And if they sign it off and it's wrong, there are criminal sanctions. There's jail waiting for you there. In the UK and a lot of the rest of the world, it is more principles-based. You don't sign off any kind of checklist. There's something to be done, or certainly no official checklist. You may have it internally. But it's principle-based. Have we been fair in reporting, you know? Does it look as though the non-executive directors are of the right caliber, the right seniority, the right experience to actually be able to make a meaningful contribution to the board? Listed companies are expected to comply. In the UK and in many countries, the corporate governance code is not part of law, not part of statute. It is in America. Sarbanes-Oxley Act is law and has the force of law behind it. In the UK corporate governance code is to be followed if you are a listed company, and it is enforced really by the stock exchange. If you don't follow it, then the stock exchange can suspend your listing, and most people don't want that to happen. And the rule adopted is you comply with the corporate governance code, or if you don't, you have to say that you haven't and explain and justify why you haven't done that. And this has to be in the annual report, which is sent to the shareholders. Any attempt that there's been of companies, for example, combining the roles, chief executive officer and chairman, have tended to cause howls of protest from the stock exchange. And any company which has attempted this has really backed down onto the very kind of bad publicity that it is in a way suggesting. Now, corporate social responsibility. What is that? Corporate social responsibility is recognizing that a company has responsibility to more stakeholders than simply its shareholders. A company occupies a space in the economy. It physically occupies buildings and land and so on. A company will run its lorries and so on over public roads. The public consumes what it is making and assumes that it's safe and so on there. To what extent? The company provides employment, you know? And what is the responsibility of a company if it wants to close down a factory and move it somewhere else? It is obviously putting some people out of a job or maybe creating them somewhere else. So to what extent should the interests of stakeholders other than shareholders be taken into account? Now, corporate social responsibility is a kind of area which is, if I say fashionable, I don't want to be unfair to it now, but most large companies like to advertise the steps they're taking towards corporate social responsibility. We never know whether they actually believe in it or whether they think it's good public relations. So many companies will advertise the fact that they give employees 1 day off a week to go and work in a charity, or they are good contributors to charitable endeavours or something of that sort. This is corporate social responsibility. I think we just have to watch a little bit about, or I come at it from slightly not quite cynical angle, but I kind of argue a little bit against full acceptance of this without any question. And I would say, first of all, I think some companies might do it because they think profit is bad. And they're kind of embarrassed about profits, and they feel if they give some money to charity or spend some money this way and that way, that will make their profits seem to be less, maybe they feel exploitative. I think one could go back and say that maybe companies don't need to be ashamed of profits. If the market is working well and people are buying voluntarily, then presumably both the customer and the company is happy. Different if the market wasn't working very well, if you had a monopoly situation perhaps, and they were exploiting their position. But high profits will lead to high tax, unless you're a company like some of the American ones, which seem to avoid most tax and so on there. But leaving aside these special tax arrangements, if you're resident in a company, you make good profits. If you're resident in a country and you make good profits, then you pay high tax to that country. And perhaps it's the government who should be deciding how this money should be spent. Shareholders, of course, if they feel guilty about the company making high profits, they can always, if they want, to spend some of the dividends that they get on charities of their choice. And there is a kind of we'll see the last point here, who decides to whom payments in respect of corporate social responsibility should be made. At least this way, we're giving the money to the shareholders. If they want to give to a particular charity, then let them choose that. Next, do directors really have the authority to make non-essential payments? It is in law the responsibility of directors to do the best they can for their shareholders. Sometimes it's couched to maximize the profits of their shareholders. And to what extent do directors actually have legal authority to make large non-essential payments to other people? One could justify small payments maybe to give good publicity, for example. Or small payments maybe to compensate people for the purchase of land from them and putting up a factory near them and so on there. This is all defendable in the name of good relations and so on. But once it goes beyond that, I think one has to be just a tiny bit cautious. And finally, who decides on the beneficiaries? If we're going to be looking at giving money away, why has a particular charity been chosen? Is it because the director is particularly interested in that? But at the end of the day, it's a shareholder's money. It's the directors being charitable with somebody else's money. I think one just has to be maybe a little bit cautious about making sure that these payments are acceptable to the shareholders. Now, whereas corporate social responsibility, there may be kind of pluses and minuses to it, and now I must say the fashion at the moment is to be very for corporate social responsibility. With companies being ethical, there is no argument but that ethics are good. We've come across this in companies being unethical, some cases in pharmaceutical companies. So without mentioning any company in particular, there was one company which had a drug which combated arthritis. And after it was being used for some years, doctors uncovered, or the public uncovered, that taking this drug was associated with heart attacks. Now, everybody knows that pharmaceutical manufacturers, they test drugs, and at some point you have to decide, I can keep on testing it, but no one will ever get the benefit. There's always the, I think, acceptance that maybe long-term, a particular drug, good for a particular disease, has got side effects. This is an acceptable risk to shareholders. But what happened in this particular case is when the heart attack information was uncovered, it became clear that there was some evidence that the company already had that this was happening, and that it didn't really publish this adverse evidence as well as they might have. And that's really when all hell broke loose. Because once you begin to think there's a pharmaceutical company, it's selling drugs which it knows it may harm some people and doesn't tell anyone it's going to harm you, then you're open to all sorts of additional problems in terms, for example, of legal claims against you, of perhaps being fined by regulators and so on, of people not trusting the rest of the products in your portfolio. So it wasn't that the drug maybe had a side effect, it was that they covered up that the drug had a side effect, an unethical situation. Another example, another famous example, was a car manufacturer. The car manufacturer, I think this was back in the 50s or 60s, had a make of car. The petrol tank was, I think, kind of behind the back seat of the car, under the rear seat. When the car was in an accident from behind, shunted like that, there was high incident of the petrol tank being ruptured and the car exploding into flame. And again, the car company knew about this, but worked out that it was cheaper to pay damages to people killed and injured in the fire than it was to redesign the car. Again, clearly an unethical decision. So being ethical will reduce your risk. I think you have to believe that you will be found out. And if it reduces the risk in a company, more people will want to be associated with it. If you always come clean about any problems with your products, people will begin to trust you. People will be happier to invest in you because they know there's nothing hidden somewhere that's going to come out and damage the company later. It will reduce costs. We're just thinking here maybe of damages, of fines and so on by the regulators. So keep those costs down. If risk is lower, then you can raise capital at a lower cost. So the cost of capital is just something you'll learn later, but the cost of capital goes hand in hand with the risk associated with it. That's why if you put your money in a bank, you get a very small percent, whereas if you put your money in shares in a company, you want a much bigger percentage return, because of course it could go the other way. So if you are an unethical company, there's high risk. People will want high returns from that, to be high dividends and high interest rates. If you are ethical, they realize you are less risky, less to hide, and so on. You will raise capital more cheaply. More collaboration. More companies will want to maybe get into joint ventures with you. You'll attract better employees who want to be associated with good and moral companies and so on there. And of course, your good reputation will bring you into more sales and so on, which is going to be helpful in the long term to people. How do we know what is ethical? And there are two sorts of approaches to this, just to mention the kind of key words that are in your notes, but not actually on the slides here. There is something, how do we make the right ethical decision here? There's something called consequentialism. Consequentialism is looking, well, if I made a certain decision, did a certain thing, what are the consequences of that? What would happen? And an example of a consequentialist approach to ethics is sometimes people say the greatest good for the greatest number. So the way you solve ethical dilemmas is to think, what are the consequences of this? How can I make a decision which provokes the greatest good for the greatest number? That won't stand up on itself. It's easy to say that that may not be the answer in all cases at all. I mean, one way of getting the greatest good for the greatest number, as a suggestion in your notes, you have got 10 sick people. They need 10 different transplants. So one needs lungs, one needs heart, one needs liver, one needs kidney, one needs eyes, and so on there. And you have one person who's going to be the source of these. So you could, in a way, argue that for killing one person, you save 10. But there aren't very many people who are going to say that it's ethically correct to kill one person, harvest all of those organs, and save 10. Although there's some interesting arguments which is beyond this. The second one is a duty argument. Sometimes the official word is deontological. Deontological approach. And this is effectively saying that there are absolute moral values which will give us guidance in any situation as to what to be done. You can have absolute approaches, you can relativist approaches, and so on as well. An absolute approach would say there's only one right decision to make in certain circumstances, and that a relativist ones is saying, well, some people think that, some people think that, and they don't get too in a way worked up or concerned maybe what is eventually done. How are we going to get ethics, if you like, into the corporate culture? And what most organizations do, if they want to get people to take ethics seriously, they need an ethical code. So, for example, in a typical ethical code, it will say maybe the company's attitude to bribery, or the company's attitude to covering up products which may harm people, and the company's attitude maybe to industrial espionage, where you spy in some way on what your rivals are doing. The code of ethics can be written, but then to make it actually work, the code of ethics has to be backed up with training and example. You have to support, for example, a culture which is maybe in favor of whistleblowing. So if somebody sees something that's been done wrong by the company, then there's maybe somebody in the company to which that person can express their concerns, maybe at board level, maybe an independent non-executive director, so that the chance of covering up wrongdoing is relatively small. Within this code of ethics, you have to claim or tell people that good ethical behavior will be rewarded, bad ethical behavior will be punished. You have to do training, you have to give them case studies, you have to explain the importance of this in terms of their career and so on. And if you don't do that, then your ethics are likely to be compromised. And long term, the ethical position of a company being compromised leads to very, very great disadvantages.